welcome back to the Investopedia podcast. I'm pleased to welcome Colin on today. Colin is the founder of Advize Wealth. He's ranked as a top 100 advisor by Investopedia. He's been featured in Barron, CNBC, New York Times, Investment News, Investors Business Daily, just to name a few. He's also a guest lecturer at several universities in their wealth management programs, including Michigan State, and is also on the board of the Financial Planning Association, helping advisors with their best practices. Colin, very extensive background. I know you have a lot to say. It's always been a pleasure chatting with you. Maybe to kick things off, I know as a predominantly fee-based advisor, I'm assuming you deal primarily with, younger, I'll call them Henrys, the high income, not rich yet crowd. What's a common pitfall you end up seeing with the younger generation when they're getting started on their investment journey?
Well, thanks, Cameron. Happy to be here. Yes, I do work with a kind of a barbell model. I love working with my own demographic, kind of that Henry generation, 30, 40-year-olds, lots of different irons in the fire. They're trying to pay down debt, trying to buy a home, maybe having kids, changing careers. So tons of different variables going on in their lives. With my traditional clients who are more in the retirement camp, where I was classically trained in the wealth management industry, serving pre-retirees and already retired folks, helping them create lasting income and generational wealth with their portfolios. But to answer your question, I mean, young people kind of have been served a pretty tough card as of recent, with interest rates going up. Like, the environment is just not been very friendly. And I think a lot of people are kind of finding themselves squeezed and trying to decide whether they want to pay their student loans this month or try to save and invest for the future or make that down payment on a home. And I think a lot of times what I find is that people are getting advice from maybe their boomer parents who grew up in a different environment and telling them that buying a home is a fantastic investment. With the data can tell you that that's almost the exact opposite. That is not probably your best wealth building decision. Now, do you have to live somewhere? Sure. Is it great to have a place that you can remodel and call home? Absolutely. Does it have to be today? Should you feel like you're being left behind if you're not doing that? No, I don't think that is absolutely the case. So I think that's what I often hear is, I need to stop burning money or wasting money on rent. That is absolutely false, because the moment you buy a home, you are now burning money or wasting money on interest. You are burning money or wasting money on your taxes. You are burning money and wasting money on your massive insurance. Like, you can just call all of that a form of rent. The amount that you're actually paying down and building equity in a home is sometimes only 5 to 10% of your mortgage payment or the expenses that you have every month. So I would not feel like you're getting lost or getting left behind if that is something that your parents are harping on you on. And then the second thing I often see is that people feel they need to already be wealthy to start investing. That is also the exact opposite. There are so many cool fintech products out there, and even just the traditional ones with your 401k at work, where if you could just get started putting 5% of your income or even a $50 a month, just automating that and getting started is absolutely huge. You'll never notice it. You're not going to see it out of your paycheck. You won't even feel it. And then all of a sudden you're going to forget about it and look a year later and be like, oh my gosh, I have a few $1,000s here and this feels really good. And it's just that first baby step, that first snowball to building wealth and making a very, very important decision and getting yourself in a better place moving forward.
Do you think that's like a byproduct of the world of instant gratification where, unless I see that immediate return, it doesn't really capture my attention?
I think so. And I don't even know if that's so true today. I definitely think it's more prominent today. We don't have to wait to binge watch a series. We're not waiting to next week. We're just crushing the whole series tonight or tomorrow or whatever the case on Netflix. I want to download it now. I want to stream it now, whatever the case. That's so true. That probably makes millennials even more impatient, Gen Z, etc. But this is true too for previous generations. Everyone wants to get rich quick. and they're always looking for the next Bitcoin, the next Nvidia, the next stock, whatever this, the shiny object. So that is not a new thing as far as human greed in civilization and in human history. So trying to maybe work past that and investing in maybe real stocks, diversified index funds, etc. That's a whole other topic, which I'm more than happy to get into.
Well, I guess, to your point earlier about taking advice from, your parents, like the boomer generation, it's, what I always liken it back to is, that generation grew up with like a pension, right? Like I worked my job. I never left that company. They treated me well. When I
Yep.
retired, I had a fully funded pension that survived me. I could focus on like vacations, everything. But, that's eroded a lot. Are you seeing, the need to put money aside for retirement for long-term wealth building is more evident for this younger generation than for the older generation because of, the lack of company resources?
100%. The pension is a dinosaur nowadays. I don't see it almost ever with anyone under the age of 45. And that was such a huge benefit that really was out of sight, out of mind, and just automated for a lot of these older generations. It was saved for them automatically. They retired and they got the pension, they got Social Security, and they never had to once think about how much should I be saving for my future? What should I be putting aside? It was kind of just spoon fed to them. And then all of a sudden, companies started realizing that they can't support paying their existing workforce and a workforce that is now living not until age 65 like they used to, or even 75, but a lot of times till age 95 or 85 or 95. And that's why they completely ripped this out and said, we cannot afford to do this forever. Saving and building wealth is now on you. And that was just such a massive pivot. And the problem is that the behaviors of that older generation were never taught and telling the importance to their kids of saving to the 401k, saving to your Roth IRA, saving to a brokerage account. Make sure you're investing for the long term. They never had to worry about that. So those were not principles that they're teaching. So I honestly think we're going to have this like really kind of lost generation of savers and wealth builders that is kind of hitting the United States especially, but really around the world. And it's going to be tough. I think people are going to be not in a great place and maybe having to be forced to work longer and not having that amazing retirement that they got to watch their parents have.
So on that note, with, comparing this versus the previous generations, I'm gonna pull a number out of my ass, but let's say, the pension was about like 10% of your income. Like maybe you had to, as a DC,
Sure.
like you had to contribute to it. With that now eroded for the younger generation, are you seeing them put away, call it that same amount, like that 10%? Or I guess, if it's a company match, it's technically 20%. Are you seeing that, or is it like a massive gap in people's financials right now?
Unfortunately, I'm not really seeing that, especially amongst the younger generation. It's not like that's really even talked about amongst HR. And a lot of times the default is that it's set to zero. So you
Mhm.
actually have to opt into it. And a lot of times you have to fill out or sign or mail in or submit whatever it takes, some type of form. And maybe it's a couple pages and you have to link your bank account, etc. Like it just is annoying. It's a task. You don't have to, it's very easy to say, oh, I'll do it next week or next month. And then all of a sudden 3-4 years go by and crap, I forgot about it. It's never on your to-do list today. Every day we have a to-do list. I got to pick up my kids from school. I got to get groceries. I have to make dinner tonight. By the end of that, the last thing you want to do is log into your 401k and deal with the hieroglyphics, the minutia. It's all foreign language. They don't make it very easy. So it doesn't get done. I know that there is some really great some laws being changed where it's almost like the opt-in, and the automatic contribution rate might be 5% sometime in the near future. I'd love to
Mhm.
see it even as high as 10%, like you mentioned, to replace the pension, which I don't even think your number is probably radically far off. And it would be really great if you had to go through those paperworks and to opt out of the 401k, because most people wouldn't do it, and they would just all of a sudden have this newfound wealth when they leave their job, and they're like, wow, I have $10,000 in my 401k. Sweet. Let me move that over to the next one, or at least be able to pay off any debt, or even use that for a down payment on a home, or whatever that the financial goal might be.
It's funny, I was listening to, I don't know if you've ever listened to the All In podcast before. I enjoy those guys. You know, it's Chamath, Jason Calacanis, Freeberg, and David Sachs. And they made the case on the last episode I watched on how the trend that they're seeing in Silicon Valley now, so, you know, like the new age of company, they've stopped giving out equity. So, you know, like one of the big perks of joining a young company was like you would get some stock options in that company. And when that company, you know, strikes it rich, whether they get sold or IPO, it's a big payday for everyone. Trend now is to essentially outsource everything. You know, like instead of hiring local devs in Silicon Valley, you look to overseas to cheap resources where like you don't have to pay for anything. So I think it's like very interesting. You know, it's to your point, the opt in is much more difficult, but it's serving the company's best interest, right? They don't want you to do that because it's another obligation on their end that they have to honor with their employee base, when it's easier just to keep everything at a minimum, no equity, no pension, and also now let's look to overseas to fund my talent pool instead of looking domestically.
Absolutely. It's just kind of another maybe strike against the employee, the average US worker, Canadian worker, European worker that's trying to build wealth for the long term. They don't have the pension anymore. The equity compensation options are going down. It's really going to be on us to open an account, have the discipline to systematically save, invest ourselves. Like, we actually need to learn at least a couple pieces. Happy to give some potential recommendations, or at least some education on the pod today about what to do with that. But we have to be picking our own funds and making sure that money is put to work and invested. I mean, even like Chamath, he got rich from company stock. I mean, he was employee like 500 or whatever. Yeah, at Facebook, now Meta. You know, he wasn't given a pension and doing all this stuff. He received equity compensation that a company just happened to absolutely strike it rich. And now the guy is a multi-millionaire.
Yeah, maybe you know, down that note, it would be interesting to hear the way you approach it for your clients. Like, is it a model portfolio approach? Is it like owning like one or two index funds, or is it more like bespoke, building a portfolio from the ground up?
Yeah, great question. So I kind of start fundamentally saying that nobody knows the future. That is just a fact. Nobody knows who's going to be the next big winner, who's going to be the loser. Is Nike going to sell more shoes than Adidas? Is etc. We could go down the list infinity to every company in the world. So if we have no idea where the future is going, how the heck do you invest? Where do you go? Do you just pick stocks? Do you try to get lucky? Well, if you believe that the markets are reasonably efficient, which I do, and what I mean by that is that you're not going to be buying and selling stocks based on the news. You know, by the time you hear it in the news or the Wall Street Journal or Yahoo, whatever the case, wherever you get your news from, the stock already knows the stock price has moved. So how in the world, if you can't trade on news, and even if you find news that is not public information, that's illegal. So you're not even allowed to trade on non-publicly traded news. I wish our US senators would abide by those rules. But for us Americans, that is the case. I mean, for anyone, for us retail traders trying to build wealth. So how the heck do you invest? Well, what I do is I fundamentally buy them all. I want to own all of the companies. So whether Facebook is the big winner, Apple's the big winner, Google's the big winner, Nvidia's the big, I want to own them all. Well, how would you do that? Do you go into your Vanguard, your Fidelity, or whatever platform and actually buy every single stock? In my opinion, no. There's a much, much easier way. You can buy what's called an exchange traded fund or a mutual fund, an ETF, they call it, which it allows you to buy multiple stocks with just one mutual fund. And a lot of times they're referred to as index funds. Sometimes in the 401k, they may be referred to as a target date fund. And you can, with one fund, now own thousands of the world's greatest companies. And actually, what's amazing is that they put them in equal proportions based on how big the company is. Because then do you buy all 3,000 US companies, in proportion? Maybe not. We should probably own them based on the size that they are. So if Google, Apple are the largest companies, those are going to be your largest holdings. And what's amazing is that the evidence has shown that investing in a low cost index fund diversified way actually outperforms in the utmost of around 90% of professional hedge fund managers and professional investment traders. So there are hedge fund, mutual fund traders who are constantly watching the news, trying to outperform the market, trying to trade on this information, maybe getting in trouble for insider trading. They're on the bleeding edge. And 90% of them over long periods of time, 10 plus years, are underperforming what you can go out and invest in 30 seconds for almost free. So it, to me, makes so much more sense that if you want to just become in the like a 90th percentile or maybe even 85th percentile of the best traders in the world, and you can just do that in 30 seconds without having to think about it, I mean, sign me up. That sounds amazing. Then you can focus your time on the things that actually matter and things that actually you can move the needle on. Like, how about your taxes? How about your income? Can you get another degree? Will your company pay for you to get your master's? Could you learn a side hustle? Maybe you should start an online store with an Amazon thing and like create some content and start selling t-shirts. Like, how could you better your skills and increase your income? That is where you should be spending your time instead of trying to pick the right stocks, because that is trying to find a needle in the haystack. Just buy the whole damn haystack. You're going to be outperforming most professionals. And then, like I said, focus on the things that matter.
You probably wouldn't outperform Nancy Pelosi.
She's tough to beat. She's tough to beat. That's true. I mean, buying these NVIDIA calls, 2 months before she passes a bill that the government's going to subsidize, millions of dollars of their chips. Man, that was a hell of a call.
It was funny. We actually looked a couple of years ago during, especially like when there's a keen focus in on it. We're like, can we make an ETF that tracks her portfolio? Turns out it's illegal. It's illegal to profit off of Congress people's trades, even though they're clearly in on the wrong. So it's like, I feel like it should be either you ban trading or you open it up where like in real time, I could see exactly her positions and then recreate that for the general American population to invest alongside the insiders.
I thought there was an account actually doing it.
They
I
have
thought it was like,
there's a few that have like models out there where you could subscribe to it, but you're not allowed to have it as like a managed product, like an ETF, because like an ETF will be making money off of it, and that's no bueno.
Okay, because I know like the Twitter now X account, Unusual Whales.
Yeah,
they follow it pretty closely, but maybe they can't be managing the portfolio. Like they can only provide news or something like that. But
exactly.
I have looked at that more than once, and it's so frustrating. I'm maybe in my gambling account, which I do have a gambling account. I like to have some fun too. And to just go ahead and put 5% of the portfolio into some of these random calls or random bets that these Congress people are making. It's unbelievable.
I do the same thing. I do like an 80-20. Like I do 80% into core index funds, ETFs.
Yep.
And like 20% is where I lose all my money, and that's where I make single stock bets that never really pan out.
There we go. Hey, at least you know the truth, and it's just the return on education / return on entertainment.
Exactly. It's my scratching my gambling itch. It means I have to get it out somehow, and that's the best vehicle to do it.
Hey, whatever protects that other 80%, do what you got to do.
Exactly. So on the note of looking online, where do you think the trend is in the industry? Like we're seeing a lot of people, a lot of young people, they entered into the market 2 years ago, probably a lot got burned since the
hmm
market downturn and GameStop crashing, what have you. Name your meme stock that crashed. Do you see that trend continuing? Like I know you also create content. Do you see it moving more online where instead of hiring an advisor, I am now looking to online creators or online communities to figure out like what I should be doing with my investments?
So I think the answer is yes to almost all the above because yes, there's going to be more DIY do it yourself investors because the fintech tools are getting so good. You can get on Robinhood and trade stocks while you're sitting on the toilet. Like there's so many public, even public.com, like the app, it's like a social media basically for trading stocks. There are so many really, really great ways. We have Wealthfront is a robo platform. Betterment is a fantastic robo platform.
Investopedia.
Yeah, Investopal absolutely is another great fintech product. And the tools out there and the resources to do it yourself are great. And then I also think that advisors creating content and creating education, and more advisors getting out there and finding niches that speak to a specific demographic or a specific person or a specific profession. They're getting deeper in all of those different areas. So I think the ability to gain education and to invest yourself is just becoming way, way more accessible. And it was only, maybe 2 decades ago that building amazing portfolios and tax loss harvesting was for the ultra rich. And
Yeah.
these ultra rich, maybe 10 million plus, were paying a 1% advisory fee, which on $10 million is literally 100 grand. Like that is out of control in advisory fees to manage portfolios. Now you can get better, at least investment portfolio management at Betterment or Investopal for fractions of that. And it's just really cool to see. So I think that it's getting more people involved, it's getting people invested better. And I think advisors are dealing with more sophisticated clients and then being able to provide top level advice. Like I'm not just spending all day making trades for my clients. Most of that is automated. So we can have really, really deep conversations about their goals, their upcoming expenses, and focusing on things that, once again, actually matter. So I could see more people being able to do it themselves and more people being able to find better advice with better professionals at a cheaper price. So I'm really, really optimistic on the future of people being able to build wealth for themselves.
So do you see it moving more towards like a a DIY portfolio managed by the client, and then they hire on an advisor more for like the planning aspect, like building the budget, building the plan to get you to retirement?
Really good question. So yes, I could see that. I do see that. I see that even in my own practice, where especially even if a client has their 401k, they can't move the money even if they wanted to, but they still have a lot of really great questions. In the past, that person really didn't even have an advisor to work with. Nowadays, I'm just charging them a flat fee as if they're paying, someone to remodel their home or paying a consultant, right? Or paying an attorney a flat fee to help them with the advice and building the plan because the tools out there exist. From like we just mentioned, all the fintech tools out there, but using them in a way to really get yourself in a great position and feel confident about your decisions. That's really where the advisor and the human aspect is probably taking place, or the education online coming from whether it's a social media account from someone you potentially know, like, and at least have some trust in, or Investopedia we mentioned. I mean, a lot of great information on this podcast, Investopal in general. So the education sources out there are vast and it's exciting.
So, switching gears a little bit to other financial market participants, I saw
Mhm.
you made a few posts about it. I see it a lot as well. It seems like there's this massive rise in people selling whole life insurance all of a sudden.
Yeah.
What's your take on that? Do you think it's the new real estate agents or like the new OnlyFans model who like wants to make a quick buck and push a high fee product on people?
It's such a shame. I mean, I have been studying my whole life, got a finance degree, went to additional education to get my CFP, and you can get your insurance license in 4 weeks and then call yourself an advisor and start slinging products and making massive, massive commissions on day one. And also, you're virtually unregulated if you don't have the option to invest people's money. All you have is the insurance license. So, and you're not held to a fiduciary standard, which means you don't have to have your client's best interest in mind. You can just run around saying whatever you want, slinging products, and it is really, really tough to see. I had a standard audit that happens every 3 years, and it was just hilarious to see how detailed they were going through my client engagements. They calculating the fees that I withdrew, asking, did I execute on the things I said I was going to do for the client? And of course, passed perfectly fine. But I even just sent them a couple of videos of these people slinging index universal life and encouraging people to cash out their 401ks and telling everyone that you can get X amount of returns in an IUL because you can leverage it and take on debt and buy more IUL. It's they're just like, this is absolutely awful. My state regulator said this. And he's like, but are they, securities licensed? No. Oh, okay. Well, we'll send it over to the insurance regulators and crickets. It's there's really no incentive to change that because I think these insurance companies are making money hand over fist sponsoring the Rose Bowl, and there's just no incentive to change, and it's an absolute shame. I do think that more education is helpful, but the problem is you give the microphone to the wrong person, and now there's
Right.
bad education out there. So, finding resources like what you're doing on this podcast is really, really cool. That's why I wanted to be here. Where we share the same mission of trying to help people make good decisions with their money, and listening to someone who got their license 4 weeks ago and is trying to make a quick buck is not the person to be listening to.
So it was my understanding that a whole life policy specifically is beneficial for more high net worth people to for like some tax efficiencies and for estate planning. Is that the case? Is that so? Like, obviously, there is probably like a use case to buy one of these products. Is it, like, what's the sort of demographic if someone's listening to this where it actually makes sense to consider it?
It is funny. I've shared that before with some of my friends. I was kind of just like going on a little rant about it, and they're like, "Why would this product even exist if it's just for ripping people off?" And it's like, well, that's kind of the same reason like alcohol and cigarettes exist. Like, it's fun. You can do it. Like, you can sell whatever the heck you want. America. Now, with that being said, there are a few use cases where it does make sense. Like, especially if you have like a buy sell agreement between two business partners and one dies, you want to make sure that the other one has enough money to buy the other one out. There's very kind of fringe cases where it does make sense. You can potentially use it as like a deferral, a compensation deferral program. You have like coaches out there, Jim Harbaugh, making millions of dollars a year coaching Michigan or now the LA Chargers. He can max out his 401k, $23,000. That's not going to make a freaking dent on his $10 million salary. So
Mhm.
it might make sense for him to defer some money into like a whole life policy. So just to simply avoid taxes today, and then he'll pay tax on the cash value estate planning issue. You could put money into a life insurance policy and then put that money into a trust. And then when you die, you could give that money to your kids in a maybe more tax advantageous way. There are ways to do it, but this is usually for folks who already have substantial wealth. What gets twisted is that a lot of people say, see, this ultra high net worth person buy whole life. And it's like, no. That was completely reversed. That person did not even think about whole life when they were building their business and how they got rich, or when they were, coaching their team program, or whatever, when they signed the $10 million salary. Let's not get the causation and correlation mixed up here. And I think that is just one of those really, really annoying things that whole life insurance or index universal life insurance salespeople will point to and say, look, at Bank of America has whole life on their balance sheet. Is Jamie Dimon dumb, the CEO of JP Morgan Chase or whomever? You should have it too. It's like, okay, they are using it for a completely different reason. Let's cool our jets for a second.
Okay, so for the general investor, if you do get solicited, probably not in your best interest. If you're making over $10 million, you probably aren't listening to this podcast anyways. And yeah.
Right. Then you can pay your advisor $100,000 fee, and they can put together, some really well thought out structured trusts and some great plans. But until you're there, until you can afford that $100,000 advisory fee, let's keep building wealth the right way.
Yeah. I think that's probably a great place to leave it, Colin. I know you are quite active on socials. How can people find you?
Heck yeah. So feel free to go to the website, advisewealth.com. Otherwise, hit me up on virtually any social media. I'm very active on Twitter, Instagram, X, with just my name, Colin Overweg. And happy to talk with people if they send me a comment or a DM. I'm very accessible.
Okay, lovely. Colin, it was a pleasure having you on.
Thanks, Cameron. Appreciate it.